And welcome back. You're still watching Closing Bell Southern Africa. And as the US presidential election approaches and the Federal Reserve and European Central Bank navigate complex economic landscapes, understanding where to invest becomes crucial. To help us explore how to navigate these uncertain times is Nigel Green, CEO at De Beer Group. So, Nigel, as I'm looking at some of the headlines that have been dominating the markets over the past couple of days, a lot has been attributed to Trump. Crypto goes up, it's a Trump effect. Looking at equities, it's Trump. I'm just curious to get your perspective on US presidential elections and what we've seen so far. To which extent is this having an impact?
It's having an impact because it looks almost certain now, doesn't it, that Donald Trump is going to win the election. How much has changed in a week? I guess you could consider whether things can change so considerably again. Probably unlikely. So markets are seeing that Donald is likely to be back as president of the US, and they're investing on the basis that his policies are likely to be expansionary, reduce tax, and the effects that it will have are being priced into the market as we speak.
Are there specific sectors that are more likely to be more vulnerable, let's put it this way, more likely to be more vulnerable to election-related uncertainties?
Yes, I think so. I think if he gets into power, he said that he's going to put a tariffs on imports. So that would call growth in Europe. So European equities have some uncertainty, just simply and solely because of that. Then the reverse of that is that you're already seeing the oil sector is doing well. He's always encouraged that and encouraged deregulation in the oil industry and also in the financial industry. So last time he was in power, the banks did well, and so did the energy sector. And of course, crypto is coming in there, and it's been put down to Donald, but he's also now said who his vice president's going to be, who also is a crypto fan. So I think lots of people are getting on board with that and seeing that Bitcoin in particular has some upside potential with a Trump-elected president.
Now, if we combine this to the Fed signaling that they could or are ready to cut interest rates, how should investors position their portfolios to be able to leverage on both cases?
I think, we always talk about diversification, don't we? You said an uncertain world. Wow, you're right. And I don't want to go down the conspiracy theory, but there's been so many things have happened in the last, just in the last week. Energy sector is likely to do well. Financial sector is likely to do well. But then, there is also the longer term of some uncertainty. If they do reduce taxation, unfunded debt increasing, okay, is at some point there is uncertainty in the future, and that leads perhaps to gold continuing its run, which has been led by China investing into gold. That could continue because you could see uncertainty return in the future because of unfunded spending by a Trump government.
Yeah. And Europe, given the ECB stance on monetary policy, how should investors position their portfolios between the US and Europe?
I think Europe has probably got more of a struggle if Trump is in charge. Nevertheless, they're probably going to cut interest rates more aggressively, you would expect. So, again, the financial sector can still do well. So I think that's one particular area. Obviously, companies that are selling into America with tariffs, then they're going to struggle. So you'd be looking at companies that are more likely to be selling into the rest of the world rather than into America. I mean, it seems like it's going to be quite difficult to be a partner to America. Interesting to see what the final outcome is of that.
So where does this leave emerging markets?
Well, if you've got a US cut coming September, almost certain, you've got Euro ECB cut, again, highly likely September. Surely that gives some benefit to emerging markets. So if you get the dollar potentially reducing, that could also reduce inflation. But just interest rates in general coming down has got to be good for emerging markets that often carry debt.
Yeah, and I guess with this increase in liquidity, which emerging markets do you think are best positioned to be able to receive that increase in liquidity?
I mean, I think all of the emerging markets are in a good position. I mean, they've struggled, haven't they? Let's be honest. So I think if we look at the markets, emerging markets have struggle to keep up with and so has most countries, with the massive growth that's happened because of tech in America. Can they catch up? Absolutely. So I think if you're looking at emerging markets, you shouldn't go for any one particular market because, again, we're shown with politics, things can change too quickly. But if you look at the stronger markets that are coming through, then they have potential. I heard the previous speaker on the news here talking about China slowdown. Again, you'd think at some stage China has to pick up, but they've really struggled. So if China can pick up, which I'm still hopeful for, then again, that should have a positive effect on the emerging markets in general.
Okay. Now, I guess the other one is cash. Are we likely to see just an outflux from cash across the board?
Yes, I think so. I mean, I think we've got a lot of people are invested in money market accounts in the US. You've also got the same thing in general, government bonds. They're going to be coming down. So I think if somebody's looking at cash and looking at fixed yield, it's sensible to try and lock in those fixed yields now. If you've borrowed money, then you'll be crossing your fingers and everything else. The costs of that's going to come down. I think we mustn't also forget that governments have got huge amounts that they owe. So America now is reaching 35 trillion. Imagine the debt repayment is $1 trillion a year. So it's actually in their interest to some extent to get these interest rates down and to really put the world in a better position where borrowing is less expensive than it is at the moment. So I'd be bullish on certain sectors in the equity market. I'd have some gold or Bitcoin just to make sure that I'm covering that uncertainty. And I'd be looking, if I was at fixed yield, to try and lock in, because I personally feel we've got certainly one interest rate cut coming for sure in September. Election, 111 days today in the US. Maybe they won't do anything in October, but you can see another cut coming and potentially 2 or 3 cuts next year. So interest rates to fall, particular sectors to do well, lock in higher rates if you've got money in cash.
Okay, brilliant. Nigel, always a pleasure talking to you. Thank you for joining us today. That was Nigel Green, CEO at De Vere Group.